Have you ever wondered why the exact moment you decide to buy a stock, it suddenly reverses and starts to crash? It feels almost personal, like there is some invisible force watching your brokerage account, waiting for you to click buy just to pull the rug out from under you. You are definitely not alone in this feeling. Millions of retail investors around the world face this exact same frustrating cycle every single day, wondering if the market is rigged against them. The truth is much simpler. Most traders are looking at the market through a single, narrow window. When you only look at one time frame, what looks like a perfect breakout on a daily chart might actually be an exhausted trend on a weekly chart or a tiny noise on an hourly chart. You are essentially flying blind, trying to predict the weather of an entire continent by looking through a keyhole. To solve this universal trap, professional traders don't rely on luck or secret algorithms. Instead, they use a structured approach that forces them to look at the bigger picture before they ever place a single dollar on the line. Imagine having a system that acts like a three-layer filter, systematically weeding out bad entries, identifying major market tides, and pinpointing the exact microsecond to strike. Today, we are going to dive deep into one of the most famous, time-tested frameworks in trading history. We will put it to the ultimate test by running a rigorous 10-year backtest on a massive blue-chip stock to see if this classic methodology can truly outperform a simple buy-and-hold strategy, or if it is just another overhyped theory from the past. The framework we are analyzing today is none other than the triple screen trading system, developed by the legendary trader and author Alexander Elder. First introduced to the public in the late 1980s, this system revolutionized the way retail traders approached technical analysis. Instead of relying on a single technical indicator, which often gives conflicting signals depending on whether the market is trending or ranging, Alexander Elder proposed a multidimensional approach. The triple screen trading system uses three distinct screens to analyze every potential trade. It acts as a strict gatekeeper. If a trade setup cannot pass all three screens, it is immediately discarded. By combining trend-following indicators on a long-term scale with counter-trend oscillators on a short-term scale, it attempts to solve the classic dilemma of trading: how to catch a big wave without getting caught in a short-term pullback. To understand why this system is so celebrated, we have to look at the background of its creator. Alexander Elder was not a typical Wall Street mathematician or a corporate finance executive. He was actually a trained psychiatrist who fled the Soviet Union, moved to New York, and began studying the psychology of crowds. This unique medical background gave him a profound insight into the human emotions that drive financial markets: greed, fear, and herd mentality. In his seminal book, Trading for a Living, he explained that market prices are not just abstract numbers, but reflections of the collective psychological state of the market participants. The triple screen trading system was designed specifically to exploit the emotional extremes of the crowd, allowing disciplined traders to step back, analyze the market objectively, and execute trades when the odds are heavily stacked in their favor. Let us break down how this system actually works, starting with the first screen, which Alexander Elder calls the market tide. The goal of the first screen is to identify the dominant, long-term trend of the asset, and it does this by looking at a time frame that is one order of magnitude larger than the one you plan to trade. If you plan to trade daily charts, your first screen must be the weekly chart. To identify the tide, we use a trend-following indicator, most commonly the slope of the weekly MSFT histogram. When the weekly MSFT histogram rises, it indicates that the bulls are in control, and we are strictly forbidden from shorting. We can only look for buy setups. Conversely, when the weekly MSFT histogram falls, the bears are in control, and we can only look for short setups. This single rule instantly saves traders from the catastrophic mistake of fighting the primary market trend. Once we know the direction of the market tide, we move to the second screen, which is the market wave. Here, we zoom into our trading time frame, which is the daily chart. The goal of the second screen is to find a short-term correction against the primary trend. When the weekly tide is rising, we want to buy a temporary daily dip. To find these pullbacks, we use daily oscillators. In our backtest, We will use the 2-day force index, a unique indicator developed by Alexander Elder that combines price movement and volume to measure the power of buyers and sellers. When the weekly trend is up and the 2-day force index falls below zero, it signals a short-term oversold condition. This is our daily wave pulling back, presenting a low-risk buying opportunity. We do not buy blindly yet. This is simply the setup that triggers our attention. Now we come to the third screen, which is the market ripple. This screen does not require any technical indicators. Instead, it is a precise execution technique designed to enter the market only when the price actively confirms our hypothesis. When the first screen is bullish and the second screen is oversold, we do not buy at the market close. Instead, we place a buy stop order one tick above the high of the previous day. If the market continues to drop, our order is never filled, protecting us from catching a falling knife. But if the market reverses and breaks above the previous day's high, our buy stop is triggered, and we are swept into the trade on momentum. This is the ultimate micro-execution tactic. It ensures we only enter a trade when the price is actively moving in our favor. No trading strategy is complete without strict risk management, and the triple screen trading system is famous for its disciplined approach to protecting capital. Once our trade is triggered, we immediately place a protective stop loss. Alexander Elder recommends placing the stop loss at the low of the entry day or the previous day, whichever is lower. To protect our profits as the trade progresses, we implement a trailing stop. In our backtest, we will use a trailing stop based on the average true range, or ATR, which dynamically adjusts to the market's volatility. If the stock becomes highly volatile, the stop widens to avoid getting shaken out. If the market calms down, the stop tightens. This systematic exit strategy removes all human emotion, ensuring that we cut our losses quickly when we are wrong and let our profits run when we are right. To see how this classic strategy holds up in the modern era, we configured a comprehensive historical backtest. We chose Microsoft as our target asset, which represents one of the strongest, most liquid mega-cap technology stocks in the world. Our backtest covers a full 10-year span, running from August 19, 2016, all the way to August 19, 2026. This period of 10 years is highly significant because it encompasses a wide variety of market conditions, including the massive bull run of the late 2010s, the extreme volatility of the 2020 global crisis, the aggressive rate hikes and bear market of 2022, and the subsequent artificial intelligence boom. We assumed a starting capital of $100,000, accounted for standard transaction fees, and set the system to strictly follow the triple screen rules with automated daily execution. Let us take a look at the high-level performance metrics. Over this 10-year testing period, the triple screen trading system executed a total of 95 trades on Microsoft. Out of these trades, the strategy achieved a win rate of 44.2%. Now, let us look at the bottom line performance. The absolute return generated by the strategy was plus 26.3%, which translates to an annualized return, or CAGR, of plus 2.4%. To put these numbers into context, we must compare them to our benchmark, which is a simple buy and hold strategy. If you had simply bought Microsoft on day one and held it for the entire 10 years, your total return would have been plus 839.6%, representing an annualized return of plus 25.1%. This comparison gives us a clear, unfiltered view of whether the active trading strategy was worth the effort. To fully understand these results, we need to look at the equity curve, which shows the growth of our capital over time. When we compare the active trading equity curve with the buy and hold curve, we notice a very interesting dynamic. The buy and hold strategy on Microsoft represents a massive, uninterrupted ride, capturing the full upward trajectory of the tech giant. However, because the active trading strategy frequently moves to cash when the weekly MACD is bearish or when daily setups are not triggered, its equity curve behaves much differently. It experiences flat periods where capital is completely protected in cash, followed by step-like jumps during strong, clear uptrends. This visual comparison highlights the fundamental trade-off of active trading. You are sacrificing some of the explosive upside of a historic bull run in exchange for a smoother, more controlled ride. This brings us to the most critical risk metric of any strategy, the maximum drawdown. The maximum drawdown measures the largest peak-to-trough decline in account value, showing us the worst-case scenario an investor would have had to endure. For the buy-and-hold investor, holding a single stock like Microsoft for 10 years means enduring massive market corrections, often experiencing paper losses of 30, 40, or even 50% during severe market downturns. In contrast, the triple screen trading system recorded a maximum drawdown of only minus 21.3%. This is where the true power of the system shines. By systematically cutting losses short and moving to the safety of cash during prolonged market downtrends, the strategy successfully shielded our trading capital from the devastating drawdowns that break most investors' emotional resolve. If we look at the year-by-year performance breakdown, we can see exactly how this risk mitigation played out during different market cycles. During explosive bull market years, such as 2017, 2020, and 2023, the buy-and-hold strategy outperformed the active strategy. This is a common characteristic of trend-following systems. Because they require confirmation to enter and use trailing stops to exit, they inevitably give up some profit at the beginning and end of a major move. However, during difficult, choppy, or bearish years, most notably the bear market of 2022, the active strategy drastically outperformed. While buy-and-hold investors watched their portfolios plummet, the triple screen system kept the trader largely on the sidelines, preserving capital so that it could be deployed efficiently when the next bull cycle began. Let us zoom in to the individual trade level to see what the anatomy of a typical trade looked like. With a total of 95 trades, the system was relatively active, averaging a handful of trades per year. The win rate of 44.2% means that more than half of our trades actually resulted in a loss or a break-even scenario. For beginner traders, a win rate around 50% can be psychologically devastating. But this is where the mathematical edge of Alexander Elder's system comes into play. Because of our tight initial stop losses and our trailing stops, our average losing trade was very small, while our average winning trade was significantly larger. The system relies on a high reward-to-risk ratio, meaning you do not need to be right 80% of the time to make a substantial profit. You just need to make sure your winners are far larger than your losers. Despite its historic fame and strong risk management features, the triple screen trading system is not a magic formula, and it has several key limitations that every trader must understand. First, the system is highly vulnerable to whipsaws and sideways, range-bound markets. When a stock is consolidating and has no clear direction, the weekly MSFT histogram will frequently flip back and forth, triggering buy signals just as the price reaches the top of the range, only to stop you out as the price falls back to the bottom. Second, because it is a multi-frame system, it requires constant monitoring and high execution discipline. Missing a single daily entry stop or failing to adjust your ATR trailing stop can completely ruin the mathematical edge of the strategy, leading to uncontrolled losses. In conclusion, our 10-year backtest on Microsoft shows us a realistic, unvarnished truth about quantitative trading. The triple screen trading system is an exceptional tool for capital preservation, volatility control, and structured risk management. It proved that you can actively trade a highly volatile asset while keeping your drawdowns to a fraction of what a buy-and-hold investor would experience. However, if your sole goal is to maximize raw, absolute returns during a historic secular bull market, a simple buy-and-hold strategy on a winning stock is incredibly difficult to beat. The choice between active trading and passive holding ultimately depends on your personal risk tolerance, your psychological capacity to handle drawdowns, and the amount of time you are willing to dedicate to managing your portfolio. We hope this deep dive into the triple screen trading system has given you a clearer, data-driven perspective on how classic trading theories perform in the real world. Here at Backtested Hub, our mission is to cut through the marketing hype and bring you honest, transparent, and rigorous backtests of the world's most famous financial strategies. If you found this analysis valuable, please hit the like button, subscribe to our channel, and turn on notifications so you never miss our upcoming backtests. Let us know in the comments below which strategy or stock you want us to put to the test next. Thank you for watching, stay disciplined, manage your risk, and we will see you in the next video.